In this week's video, we'll review 5 new stock market studies that tell us, from a historical perspective, the bull market road could get quite a bit tougher. In this segment, we'll cover some shorter-term tactical issues that will provide some context for the longer-term topics in the remainder of the video. This is a maximum drawdown chart for the S&P 500. It's dated January 29th. That's a Friday. This is as of the close post 4 p.m. We covered this chart in more detail last week, so you can go back to last week's video if you want to. Quickly, we still have potential support relative to price in several areas close by. Typically, if price is going to break down in a serious and sustained manner, we will see evidence of economic fear on other charts. 10-year yield as of the close on January 29th, Friday. Really don't have that here yet. This is what fear looks like here, Q1 of last year. Don't really have it. It's possible that if the S&P 500 can continue to rally and right itself, that this area up here will represent significant resistance, and this is where the S&P 500 potentially could run into problems. It's also possible that this will act as resistance and will move in this direction. Moral of the story here is we really don't have evidence here and in many places yet, hard evidence screaming economic fear. It may happen very, very soon, as early as Monday of next week, but we don't have it yet. Similar situation here, JNK relative to IEF. We've covered this before in the past. This is our stall resistance look, Q1. Notice where the stall starts. The S&P 500 goes on and rallies for several more weeks in here. We do have a stalled, somewhat of a failed breakout look here, but it doesn't necessarily mean that if bad things are going to happen, they have to happen right away. And it's also possible that, like other charts near resistance in this area, this could break out. So this too, somewhat indecisive and to be determined at this point. We'll continue to trade the chart in front of us. And thus for clients, in terms of profit taking, we're taking somewhat of a balanced approach here based on the data that we have that is somewhat mixed and the setup in the S&P 500 index. This is a DeMark chart as of the close on Friday, January 29th. DeMark charts and indicators are proprietary tools from Market Studies, LLC. This is the S&P 500 again, potential support. We really covered this in the past. This represents potential support. This represents a potential upside target that has not been met yet at 39.07. This potential support in this area, this is a TDST level at 35.77. Remember that. 3,500 comes up several times in the video. The two extreme scenarios, bullish, would be that this area of potential support holds and we rally back into this area and we learn something else. If we get here, it depends what the big picture looks like relative to what we would be doing. Means trade the chart in front of you. Also possible we would learn something early next week if we blow through all of this like a hot knife through butter. Thus, somewhat of a balanced approach to taking some profits this week and taking a wait and see on potential next moves. In recent weeks, we've been asking and answering the question, does it look more like the beginning of the end or the end of the beginning? It's noteworthy that both questions contain the end. These are the summary bullet points from January 8th that we covered in last week's video as well. We'll be talking about the same topics and updating them based on the latest information. Prior to reviewing the studies from time to time, it's always good to ask and answer. How can you make decisions using only technicals? Aren't you ignoring this important fundamental topic or question? Clients and regular viewers know that charts and data reflect the net aggregate opinion of all market participants regarding all subjects on all time frames. Even during uptrends in the market, there are always people with bearish opinions. The net aggregate opinion when we're in an uptrend in the stock market is bullish. When we move sideways, it's an even battle between the bulls and the bears. And then eventually, on any time frame, you hit a tipping point and we go into a downtrend where the net aggregate opinion of all market participants regarding all subjects on all time frames flips from net bullish to net bearish. This tells you that even in the strongest of strong bull markets, since the March low, you can find countless people on Twitter, talking heads on TV, that have been bearish. The same is true during bear markets. You can always find bulls. The objective for all of us is to stay on the right side of the market and the right side of this important equation. Thus, there is no, yeah, but what about this, that market participants have not considered. If you can consider it, or you can ask, yes, but what about this, it's known information. It's already reflected in every chart that we cover in these weekly videos. If you can phrase it as a question, that means the market has considered it. Thus, the only interpretation or opinion regarding any fundamental topic that impacts asset prices is the market's interpretation or opinion. And there's no law that says our personal opinion has to agree with the net aggregate opinion of all market participants. But it's the net aggregate opinion of all market participants that moves our account balances. To try to stay aligned with the net aggregate opinion, let's get into our first study regarding the S&P 500 index. We're going to be moving very, very quickly because we've covered rate of change studies in the past. Earlier this week, it had been 213 trading days since the S&P 500 bottomed in March of 2020. Only 2 previous times in the last 80 years have we seen a rate of change move like this and like this, very similar to the rate of change move off of the March low. Thus, historically, this point in 1983 and this point in late 2009, early 2010 is similar to January 21st of 2021, or this point here. When we're in a strong uptrend, it's only a matter of time before the market study tables start to show some orange, red, and yellow. This study tells us that things could be a little bit more challenging looking out 1 month to 12 months. But really, nothing has changed from a longer-term perspective. 2 years later, average gain 14%, 3 years later, 39%, 4 years later, 70%, and 5 years later, a tad over 70%. And given the look of the left side of the table, it is not shocking that our maximum drawdown, looking out 1 year in the 2 historical cases, starts to get into painful territory. If we experienced a similar drawdown from the date of the signal in 2021, this is what it would hypothetically look like on a 2021 S&P 500 chart. There are 3 drawdown figures shown on your screen represented by the 3 horizontal lines, telling us it would be 100% normal and to be expected sometime over the next year for the S&P 500 to revisit 3,500, even if really good things happen looking out 2 years, 3 years, 4 years, and 5 years. And this type of drawdown is not really any different than the drawdown that we covered in last week's video. These lines are sitting right around 3,500-ish. This teal line here that we covered last week is sitting right below 3,500. Now let's take these 2 historical cases and focus in on this portion of the table. First signal date was June 6, 1983, left side of your screen. Let's look at the chart for 1 year from June 6, 1983 out to June 6, 1984, and see what we can learn about possible volatility walking forward. One of the reasons why these studies are so relevant, on June 6, 1983, if you look backwards, investors just experienced a massive rally off of a low. Very, very similar to the massive rally we've experienced in the present day. Thus, it's not particularly surprising, walking forward from June 6, 1983, that the stock market was relatively volatile. This is somewhat of a form of consolidation from the date of the signal, which would be similar to January 21st, 2021. The maximum gain from this point to this point was 4.74%, and it took 126 calendar days to get there, several months. After that, the S&P 500 had a big give back. The maximum drawdown, looking out 1 year from the date of the signal, we fell 8.83% below the blue line. And that happened 358 calendar days from the date of the signal. We just looked at the June 6, 1983 example. Now let's shift gears to the January 4th, 2010 example, which is similar to walking forward hypothetically from January 21st, 2021. From the date of the signal in 2010, which came after the major low and a massive rally in 2009, like the first case, it started out pretty volatile. There was a relatively sharp give back and then a gain of 7.44% above the blue line from the date of the signal. And that happened 109 days from the date of the signal. Hypothetically, that would be similar to walking forward 109 calendar days from January 21st, 2021. So we had a massive rally in the rearview mirror here. Now it's an even larger rally here. Thus, not particularly surprising that we had a major give back. This is the flash crash here. This 9.74% is the drawdown from the date of the signal, so this is obviously a bigger drop than 9.75%. The low came 179 calendar days after the date of the signal. And then the bullish trend in the bull market resumed, and the market went on to print a higher high above this level here. Date of the signal was January 4th, 2010. This is a 1-year chart. It takes you to January 4th, 2011. The studies are very, very similar, so we'll be moving very quickly. Now we'll be looking at the value line geometric index. Similar concepts here. This is a weekly chart. It goes back to 1980. Only 2 previous times have we seen a 43-week rate of change similar to what we have in the rearview mirror in 2020 and 2021. Thus, it's only happened 3 times in the last 42 years. 2 of them came after major lows in the stock market. After the low in 1982, we rallied until June 10th of 1983, which is similar to the present day. And in the 2009 case, we rallied until Christmas Eve 2009. In both cases, you have a massive rally in the rearview mirror. Walking forward, similar outcomes. If we look at each case, we'll start with June 10th, 1983, very, very similar to what we just covered. In this case, the maximum gain above the blue line from the date of the signal was a little bit over 6%. It was all given back and then some. And your maximum drawdown from the date of the signal or the blue line ended up being 7.62%. It occurred 354 calendar days after the date of the signal. Quickly, we'll look at the Christmas Eve 2009 signal. Once again, a somewhat volatile market. This is the 200-day moving average. Notice we drop below it, but we stay near it, which is not what happened in recent years. This is the gain after the date of the signal. This is the drawdown from the date of the signal, and the market went on to print a higher high 12 months out. Let's look at market behavior before the date of the signal. This is the 1983 case. This chart is dated June 10th, 1983, which is the date of our signal. Trying to understand context here. This chart goes back 3 years on the S&P 500. This is the 200-day moving average. Quite a bit different look, Christmas Eve 2009 case. Once again, this is the date of our signal. We're looking backwards for context. If we put a similar chart up for the present day case, you can see that there are some similarities and some significant differences. Probably fair to say the present day case is more like the 1983 case. We have somewhat of a high and a base and a breakout, and we're extended from the base. A high, somewhat of a base, a breakout, and we're extended from the base. It's not really what we have at all in the 2009 case. Also noteworthy, on the date of the signal, the market was approximately 17.85% above this base or the green line. We're a little bit less extended in the present day, about 11.76%. Since we're talking about bases, this is also relevant going forward. Now we're looking back 3 years on the NYSE composite. We're not that far above the high from Q1 of 2020. We're not that far above the high from way back in 2018. In this case, we're extended approximately 10% from the base. This represents potential support, potential support, potential support. There's also a message in here about investment opportunities and risk and reward going forward. We're still using the dates from the value line study. June 10th, 1983 is similar to the present day, and Christmas Eve 2009 similar to January of 2021. Once again, it's context. On the date of this signal, you don't know what the future looks like. This is all you know. This is what the rear view mirror looks like, looking backwards from the date of the signal, June 10th, 1983. Approximately 14% above an upward sloping 200-day moving average. This shows the rally on the first day after the major low. Once again, present day, somewhat similar to 1983. This is the first day after the major low, all the way to mid-January 2021, or the date of the signal. Similar situation, price is about 15% above the 200-day moving average. This is a little bit different here. In the 1983 case, the date of the signal, it had been 10 months since price touched the 200-day moving average. The present day, it's quite a bit less than that, only 6 months. We tagged the 200-day moving average last in the summer. And the slope of the 200-day moving average also tells us something about the strength and sustainability of the trend. In trends, the steeper the slope, the higher the probability something's going to go wrong. The more tame the slope, the more sustainable the trend can be from a longer-term perspective. If we look point to point, using the 200-day moving average and compare the slopes from the first day of the rally after the major low, you can see we're quite a bit more tame in the present day relative to this slope here, but once again, somewhat similar. This looks a little bit more sustainable than this, but not significantly different. Similar study, this time using the NYSE composite. Remember, the CCM market model uses a weight of the evidence approach. It's relevant that we're seeing signals on the S&P 500, the value line geometric index, and the NYSE composite. Our study approach is a little bit different here. Instead of saying it's the day that we hit the blue line, we found the apex of the 213 trading day rate of change. This is somewhat more of a worst case scenario when the rate of change starts to fall. Thus, we really don't know the date of the signal in 2021 because we don't know if this has hit an apex similar to this or this yet. But what this tells us is when that does happen, what could we possibly expect? Once again, our signal comes in 1983, 2009, 2010 area. No other period since 1980 has seen something similar to this type of rally after a major low. And since the dates of our signals are similar, June 1983, June 1983, January 2010, Christmas Eve 2009, very, very similar here, June of 83, early January 2010. Thus, we would expect the results to be similar. They are. The drawdowns are similar as well. This is an example of the market needs to consolidate its gains. The market needs to consolidate its gains. Wouldn't be surprising if the market needed to consolidate its gains at some point over the next 1 to 12 months. If you want to be a glass half empty person, you can focus on the left side of the table. The left side of the table is relevant for profit taking and risk management. However, the only other times that we've seen something like this is after the major low in 1982 and after the major low in 2010. That's good news. That's not bad news. Thus, moral of the story, we should be maintaining a prudent balance between respecting 1 to 12-month uncertainty. We should continue to nail down some profits and consider nailing down profits when we get an opportunity. And we should respect that history is still telling us to remain open to much better than expected long-term outcomes. Average gain 2 years out, 14%. 3 years out, almost 40%. 4 years out, almost 70%. It's very, very important that we don't forget, this is not just a bunch of lines on a chart. Clients and regular viewers know that charts are a reflection of human behavior. And behavior in markets is made up of early adopters and late adopters, which tends to be tied to major extremes in sentiment and overbought and oversold conditions. You want to see all of this on the chart? Low, 1982, extreme fear after the market has tanked. No possible way stocks could go up. When you get up here, no possible way stocks can go down. Low, 2009, the world is ending. There is no possible way stocks could ever go up. When you get up here, no possible way we'll ever have a correction again. If that's the way it played out here, very, very similar in terms of the numbers and human behavior in the 2020-2021 case. Notice, we never get up here except in 1983, 2009, 2010, and in the present day. Thus, it's helpful to know what happened next from a shorter-term perspective and a longer-term perspective. Remember, this takes into account every single fundamental question that you can ask on every single time frame that you can conceive. And historically, from a situation of extreme and rare confidence, the market consolidated its gains and had some pretty significant givebacks over the next year. But after that, really good things happened for a long period of time. And that's really good things continued to happen. If you know your market history, anything that says 2020 was similar to 1982 and 2009 is a good thing from a long-term perspective. But we have to be realistic about what history tells us after something like this happens. Moving on to study number 4, based on the Dow Jones Transportation Average. Exact same concepts. We're looking at the trannies going back to 1980. Not surprising because we're talking about human behavior based on the fundamentals of the day. The dates, once again, are very similar. June of 1983 and January of 2010. The only 2 times it's happened looking back all the way to 1980. The third time, tagging the line and going above it, in January of 2021. And once again, we're doing the apex here, so we really don't know exactly what the signal date is in the present day. But we do know this. Eventually, this line is going to peak. A rate of change like this can't continue forever. Since the dates are similar, not surprisingly, the table is similar and the maximum drawdown is similar. From a weight of the evidence perspective, it's relevant that we can find a similar signal on the S&P 500, the incredibly broad value line geometric index, the broad NYSE composite, and the economically sensitive transportation average. Study number 5, based on the VIX. This approach is a little bit different. We only have data for the VIX going back to 1990. Only one previous time in the history of the VIX have we seen a 213-day rate of change fall from the top blue line and hit the bottom blue line. Once again, 2009 after the major low, and in the present day after the major low in 2020. This study helps us keep an open mind about better than expected outcomes. In this case, the market was higher 2 months later, 3 months later, 6 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. The gain 5 years out, 86.54% in the S&P 500. After this date here, which is similar to Q1 of 2021. The stock-related studies tell us to keep an open mind about a more challenging environment over the next 12 months. The VIX study tells us to keep an open mind about better than expected outcomes relative to these tables. And the stock study, along with the VIX study, both of them say good things could happen for a long period of time if you can do the right things over the next 1 to 12 months. All of this is helpful because the charts and the studies help us maintain maximum flexibility by remaining open to a wide range of outcomes from wildly bullish to wildly bearish. And that enables us to trade the chart in front of us with a flexible, unbiased, and open mind. That all sounds great, but ask yourself, was it helpful to have a flexible, unbiased, and open mind in April and March of 2020? Was it helpful to have a flexible and unbiased open mind when the market started to plunge in February of 2020? When the market makes a move that's only been seen 2 other times dating back to 1980, it speaks to investor confidence about future economic outcomes, and in this case, that confidence was warranted. The market did go up for a long period of time, and the economy did improve. However, when sentiment gets extended, and when markets get extended, we know with 100% certainty at some point reality is going to set in, and the market will need to consolidate its gains. The stock studies that we've covered say that in the present day we might be reaching a stage of extreme confidence. And anecdotally, and I emphasize the term anecdotal, last night this tweet was out on Twitter for 4 hours, and it basically said, hey, it's possible that the studies might get a little bit more nerve-wracking walking forward. It's a small point, but no retweets. Nobody really seemed to want to advertise that the probability of something bad happening might be increasing. In fact, took a screenshot 14 hours later, still no retweets. And if we pop back to the Twitter feed around 3:15 Eastern Time on Friday, still no retweets. Hard to say that this contradicts any of the 4 stock market studies that we covered in this week's video. The nature of the present-day stock rally, looking in the rearview mirror, tells us it's prudent to prepare for the end of the beginning. Odds are increasing that it's coming soon. That's not a disaster. In fact, it's really good news. Once again, if you look like 1982, 1983, or 2009, 2010, and you're a long-term investor, that's wonderful news. Like a Fed statement, we need to edit these bullet points from time to time. Probably fair to say the long-term outlook remains constructive. The shorter-term outlook is starting to look a little bit more cloudy. Been talking about a correction in Q1 for weeks. That it wouldn't be shocking still applies. The VIX study tells us that we should not assume anything. The studies help us keep an open mind about a wide range of outcomes. And it's possible you might say the tone of this video has changed radically. Well, the data has shifted a little bit this week, but can't emphasize enough. The maximum drawdown that we covered in last week's video was this teal line, 34.93. Studies that we did this week tell us in the next 1 to 12 months, it wouldn't be shocking if we went back near 3,500. Basically the exact same conclusion that we discussed last week from a worst case scenario. And if it gets worse than this, then we learn something about longer-term bearish probabilities. The chart in front of us helps us with the timing of all of this, from wildly bullish scenarios to wildly bearish scenarios. And this week is an example of why maximum flexibility is so important. When the data shifts, it can shift quickly. It has possibly started to shift. That doesn't mean that if bad things happen sometime over the next 12 months, that good things can't happen first. That's why it's so important to trade the chart in front of us. And the only way that we can do that effectively is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Ciovacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.